I'm Bill Dodd, and I welcome you to my video course, An Introduction to Investing in the Stock Market. I should start with a disclaimer. All views and information expressed in this course are made available for the purposes of information and education only, and are not investment advice. This course is offered without consideration of any investor's objectives, personal financial situation or needs, and as a result, no one should rely upon the information or commentary that I offer without seeking competent professional advice. Just briefly, let me discuss why I believe investment knowledge is so essential. In the recent bear market in 2008, many investors lost a significant part of their assets. In many cases, this happened because they didn't know how to manage their investments and left this responsibility to others. Some of these investors, perhaps many of these investors, will now have to depend upon a government pension. The quality of life in retirement depends not just on accumulating assets in a superannuation fund, but it depends on how well those funds are actually invested. This course aims to provide investors of all ages and all backgrounds with an understanding of investing in the stock market and provide the background needed to become financially independent. Briefly, the objectives of the course. On completion of this course, you should have an overview of investing in the stock market. You should appreciate the risks in investing and how these risks can be managed. Have an understanding of the need for an investment plan. Have an overview of fundamental and technical analysis. Understand several methods for selecting a stock. And know how to use a stockbroker and to buy shares. This is the way the course is organized. The course assumes an understanding of the introductory information which is available in the introductory video from my website. An outline of the course and the content of each session is available in PDF format for download from the free resources pages of my website. The course is organized into 10 sessions, each varying in length from about 25 to 40 minutes. And while each session is independent, there is a logical sequence to the sessions, and probably most benefit will be achieved by viewing the sessions in order. The videos of each session can be paused at any time, and there are exercises included to give a better understanding of the principles being taught. Please contact me should you need further assistance. There's a lot of information about shares on the stock market. Let me talk briefly about books and also information available on the internet. If you only ever buy one book on investing, this book by Colin Nicholson is the one I would recommend. I'm going to talk about these books by Alan Hull and by Roger Montgomery, and these 4 books are also ones which I'll refer to from time to time during the course. On the internet there's a huge amount of information. This site, Investopedia, has a wealth of information on investing, and I'd refer you to that for any specific information. The ASX site, the Australian Securities Exchange site, is a wonderful resource for investors, and Colin Nicholson's site and the Incredible Charts site are both ones that I'm going to refer to from time to time, and they contain very useful information. Let's start with some terminology. Stocks and shares are used interchangeably, but they are in fact different. The stock really refers to the company or the capital of that company, whereas a share refers to an interest in that particular company. Investors versus traders. I'll use an investor in the sense that an investor is someone who buys shares with a view to perhaps holding in the longer term and getting a dividend. In contrast, the trader would have a shorter term outlook, would not be interested in the dividend per se, but be interested in capital gain. The index, when I refer to the index, I will be referring to the ASX 200, which is the top 200 stocks by capitalization on the ASX. But there are many other indices. One which is perhaps more broadly known in Australia is the All Ordinaries Index, which refers to the top 500 stocks by capitalization. And of course, from time to time, I'll refer to international indices such as the DAX, which is the German index, and the Dow, which is the American index. Bulls and bears. The term bull is one that's given to a person who's optimistic and is buying and is pushing up the price of stocks, whereas a bear, by contrast, is someone who believes that the price will go lower and is selling and is dragging down the price of stocks. Blue chips and speculative stocks. A blue chip tends to be a stock of larger capitalization, will be a business which pays a dividend and has a long-term future. By contrast, speculative stocks tend to be stocks which are not paying dividends. They may be poorly capitalized and they tend to be high risk. We have many speculative stocks on our stock exchange because we have so many speculative mining stocks. The sectors. All stocks are organized into sectors, and GICS refers to the Global Industry Classification Standard. This is an international standard where the agreement is that stocks will be arranged into specific sectors. Market capitalization refers to the value of that company or that stock. If a company has 1 million shares and the market value of those shares is $8, then the market capitalization of that stock is $8 million. Let's start into the first session of investing in the stock market. And this session deals with risk management and the importance of the investment plan. Okay, let's start into the first session, which comprises risk management and the importance of the investment plan. Successful investors have a number of things in common. They have knowledge of how the market works, of market analysis, of understanding the role of psychology. And psychology is to do with hope and greed and fear, those human emotions which make investing so difficult. Successful investors have an investment plan, and this is the basis of all the investment decisions that are made and is the blueprint for risk management, and it removes the emotion from the investment decision. And the successful investors will also have discipline, patience and experience. Now, what can I give you in this course? Well, I can give you the knowledge, I can give you the preparation for investing. When it comes to an understanding of psychology, this is something which is going to be gained with experience. And these latter three, discipline, patience and experience, will come with time. Now, what returns can an investor expect from the share market? Well, an investor should have an aim of a return which is always comfortably above the inflation rate, and try to get a return which is above the long-term market average, which is 12%. So this means we have two reference points. First of all, it's the rate of inflation, which in the very long term is 4%, although at the moment it's a little less than that, and the long-term market return, which is 12.5%. We need to consider realities of investing. 70% of investors lose money in the market. Investing is not a zero-sum game, simply refers to the fact that there are significant transaction costs involved investing in stocks. We'll talk about that as we go further. And finally, as an investor, I need to work out what returns do I need to achieve my investment objectives. Now, investing does entail risk. As an investor, preservation of capital is absolutely essential. Can I ask you, how would you have managed this next investment? Now, this is an investment in which we probably would have bought into at around about this point. So we bought in at about $3.50 and it went up to nearly $10. So it's a matter of how we would have managed that investment. Would we have sold out at an earlier point before it reached its $10? Would we have sold out at $10? Or in fact, did we hold it? And if we held it, this is what happened, and many investors are still holding this particular stock. So there are risks involved in investing, and not all investments will be winners. Some investors expect that all their investments will be winners, and as a result, they become emotionally attached to the stock and they hold it too long. When we buy a stock, there's no way of knowing if the analysis is correct. The stock might well be a loser. The market might move against us. What we have to do here is use stops, which will get us out if something goes wrong with the trade. We can't expect that all of our investments will be successful. In fact, 70% of winners is good and 80% is excellent. So that means that the remaining 20 to 30% were failing investments, and we had to sell those quickly. We will be losing investments, so we must have risk management strategies in place. We must calculate the risk of loss on any investment, and we must use stops to avoid significant losses. But what are the risk factors and how can they be handled? Risk. Risks in investment must be managed. Let's have a look at the different categories. There's market risk. If the market falls, most stocks will fall too. So we have to understand the position of the market. We'll talk about that in depth later. Specific risk is the risk that the stock we buy falls in price. We can solve this problem by looking at diversification and the 2% rule, which we'll talk about shortly. Liquidity risk. The market for this particular stock is too thin, or in other words, it's not frequently traded, and we would avoid investing in this sort of stock. Financial risk is the risk that the company that we invest in has a high debt, so we would avoid stocks with high debt to equity ratio, so we can eliminate that risk. Credit risk is the risk when an investor borrows money. Exercise care if you're going to borrow money. If we don't borrow money, we can eliminate credit risk. And finally, currency risk. If we invest in overseas stocks and there's currency movement, there is a significant risk. And we can either hedge the currency or we can avoid investing in overseas stocks, so we can eliminate that risk. Now, many of those risks can be avoided, but there are two of these risks which we can't avoid and we have to manage. One is market risk and the other is specific risk. Let's have a look at them. First of all, managing market risk. And market risk, as we said earlier, is the risk that if there's a market correction, virtually all the stocks are going to fall. We need to understand market risk, and one way we can understand market risk is by looking at a weekly chart of the ASX 200. Now, this is the index of the top 200 stocks, and this is the first chart that we're going to see in this course. Now, the chart is a record of the performance of this stock. We have on this axis here the price, and on this axis here we have the time. Now, what's of interest here is market risk, and because the market will fluctuate, here we've gone from a market which was moving sideways into a market which was moving very rapidly upwards. We'd call that a bull market. And here we go into a phase where we have a bear market. It's going down very dramatically. Now there are periods in this chart where there's low risk. So this is a low market risk. This is the time we can be buying stocks at low risk. This is another time when we can buy stocks at low risk. And by contrast, this region here is not the region that we would want to be buying stocks in. So we can get some idea of market risk if we have an idea of what's happening to the underlying index. So market risk can be managed by entering when the market risk is lowest and looking fairly closely at what's happening in world and Australian markets, and we do this by using fundamental and technical analysis, and importantly invest over time. Now, by this I mean that if one was to suddenly inherit $1 million, it would be high risk to put all of that money into the market immediately. So what one would do would have a planned strategy where you'd invest perhaps 10% this week, 10% the next week, more the next week. So invest over time. Managing specific risk. And this is the risk that a single stock will fall in price. Specific risk can be managed by managing the size of the position. In other words, this is how many shares you actually buy. And we use the 2% rule to manage this risk. And secondly, we use diversification to minimize specific risk. Let's look at the 2% rule. The 2% rule manages position size, or in other words, how many shares we're going to buy. So what is the 2% rule? The 2% rule says that no more than 2% of capital can be risked on any one investment. It allows an estimate of the number of shares to buy in any one stock. And let's take an example where the investment capital we have is $100,000. Now, when we're buying a share, we normally buy a share in a rising trend, and we buy it when it takes out a previous high point. So an ideal time to buy this particular stock was when it broke out from the previous high at that point there. So let's say that we can buy shares in the stock at 46 cents. There has to be a point at which our decision to buy this stock was wrong. Now this we believe is an uptrend, but in fact if it falls below this previous low, this would suggest that this market is going to fall lower. So if after having bought these shares, the share price falls below this point, then we would sell them. So this is the point at which we put our stop. So our stop loss in this point is at 39 cents. So we buy the shares at 46 cents with a stop loss at 39 cents, which means the risk is 7 cents per share. With a capital of $100,000, the risk is limited to 2% of 100,000, which is $2,000. This is the 2% rule being applied. The number of shares to buy is $2,000 divided by 7 cents, which is 28,570 shares. The outlay is $13,000. Now, the idea behind this is that if we bought these shares and the worst case situation occurred when the share price fell below 39 cents, we would then have to sell them, and our loss would be no more than 2% of capital, which is $2,000. As an exercise, I'd like you to consider the following example. How many shares of Woolworths can be bought with available capital of $100,000? The investment plan states that the maximum risk on any one investment is 2% of capital. So, here we have a chart of Woolworths, and it looks as if the Woolworths chart has formed a base pattern. So we would buy our shares when they rise above the previous high. So what we're doing here is, first of all, estimating the buy and stop points. Our buy point would be when it rises above its previous high at this point here, and this is our stop when we would make the assumption that if the share price fell below that point, that in fact that stock was going to fall and not rise. This would be the point at which we would need to sell it. So our point of buying here is $27.50, and our stop is down here at $26.50. The risk per share is $1. So the risk that we allowed under 2% rule is $2,000. Therefore, the number of shares we can buy is 2,000 divided by 1. It's 2,000 shares. We see how specific risk can be managed to limit the risk of buying Woolworths shares so that no more than 2% of available capital could be lost at any one time. The investment plan in fact allows us to buy $55,000 worth of shares. The outlay on Woolworths shares in this case is $55,000. Now in this last example, that of course is 55% of our total capital. If we invest 55% of total capital in a single stock, this increases our portfolio risk, and we need to consider diversification. So diversification further reduces specific risk. And what we mean by diversification is that most investors would require a diversified portfolio comprising a minimum of perhaps 10 different stocks, and perhaps not more than 10% of the total capital being allocated to any one stock. Now in this situation, it would mean that our purchase of Woolworths in this last example should be limited to no more than $10,000. So in fact we would not spend $55,000 on Woolworths shares, although it was allowed under the 2% rule. We would limit our expenditure there to $10,000. Diversification also means that the 10 stocks, if they're allowed in this particular portfolio, should be spread over different sectors, and these are in fact the different sectors. So all stocks are allocated to a sector. When we're buying stocks, it's essential that we don't put too much of our capital into a single sector. Market risk and specific risk must be managed, and the investment plan is the essential tool. The investment plan should be written so that it helps to manage risk, to manage the investor's behavioural problems under stress, and to provide strategies to select, buy, manage and sell stocks. The important thing about the investment plan is that it evolves and it is never finished. Let's consider an example of why an investment plan is essential. Consider the following example. It's 2005 and you're interested in buying shares in Centro Property Trust. The fundamentals of Centro seem to be very sound, and it seems that Centro would be an excellent investment. Consider the chart of Centro Property Trust. So that's the weekly chart of Centro Property Trust, and we would consider buying on the breakout from the previous highs, so shares could be bought at $4.85. This is potentially a profitable investment. So how would we buy and manage this investment? The first step is to look at the investment plan. Now, the available capital is $100,000. Shares of Centro Property Trust can be bought at $4.85. So the investment plan now tells us how many shares we can buy and how we can manage this investment. First of all, is this a buy and hold investment? No, we need to manage this investment. Is a stop loss needed? We definitely need to use a stop loss, and we need to know where we're going to place that. How many shares can be bought and what is the risk? Our concern here is specific risk. How will the investment be managed? We're going to use a technical approach, and these are some of the important guidelines we get from the investment plan. Let's go back to our chart of Centro Property Trust. We need first of all to calculate the number of shares we're going to buy. So let's go back to the chart of Centro Property Trust and recognize here that we are managing specific risk. We're going to buy the shares at $4.85, and we need to work out where to place the stop, and the stop would be appropriately placed at this point. And this is a selling point of $4.10. So this means that the entry price is $4.85, the stop loss is $4.10, the maximum risk per share is 75 cents. The maximum risk to capital that we are allowed is $2,000. This, of course, is the 2% rule. So the number of shares we can buy is 2,000 divided by the risk per share, which is 0.75. We can buy 2,666 shares in Centro Property Trust for an outlay of $12,900. So we bought the shares at $4.85. The question is now, how should this investment be managed? Consider the outcome of this investment. We bought in at $4.85. It rose to $10, and then the share price plummeted. It's a matter of working out where we should sell this stock. More about managing stocks in later sessions, but at this point we would sell this particular stock when we believe the trend had finished. And at this point, this is the end of the trend. We can definitely say it's finished, so we would sell at $8.40. Why not sell at the top? Well, it would be very nice if in fact we knew that $10 was the top price and we could sell in the market then, but the point is that we never know how high a stock is going to go. So we will never buy a stock at the bottom and we'll never sell at the top. We hope to capture something like 60 to 70% of this trend, and if we can do that consistently, we'll be very successful as investors. So we don't sell at the top because we never know where the top is. Conclusion. As a managed investment, Centro Property Trust returned a 73% profit. In late 2011, the share price was 3 cents, and after a 99% loss of capital, there was no dividend. And there are investors that are still holding this stock. So with a sound investment plan, this was a great investment. But without a plan, Centro Property was a disaster. The investment plan is the key to buying and managing the investment. It also protects the investor from making poor and emotional decisions. Now, what do I mean by emotional decisions? Let's have a look at this chart again. The thing is about investing is that we can look at a stock, we can do the analysis, and we can be quite impartial, but as soon as we buy it, we become emotionally attached. So there's a lot of emotion attached to investing, and this is what makes it so difficult. So if in fact we decided to sell at 840, we did very well. But what if we didn't sell? Well, there was another possibility we could sell there, and that was really the last point at which we should be selling that stock. Now, it's emotional. We've already seen this stock fall from a point up here of $10 down to $7. It's emotional, and the tendency is to think, well, maybe I'll hold it and maybe it goes higher. What if we didn't sell it at the point of $7, and a few weeks later it's at $3? We didn't sell it then, it's now at $2. We didn't sell it then, and it's now at about 30 cents. This is all very emotional. So emotion is a very important part of investing, and the way we control it is by having an investment plan. As an investor, I must understand that I cannot control the market. I can control the amount of money I'm prepared to risk. I can control when I sell, and I can control my attitude to the market. Now, I've got a couple of question marks after that, because yes, we can control our attitude to the market, but we're talking here about human psychology, and it's difficult, it's not easy, and it takes a time to learn. So after some experience as an investor, you will also get to the stage where you can controlling attitude to the market. But all of these facets are controlled through the investment plan. The investment plan is the key to such controls, and I think the example of Central Property Trust illustrates that. We have an investment plan because investing needs to be treated as a business, and it must be planned. An investment plan includes a number of unbreakable rules and some guidelines to manage the investment process. The idea is to start with a simple plan and add to it as you continue to invest. The important thing to understand is that you can start with a very simple plan and then you upgrade it. An investment plan is never finished. What's included in the investment plan? As investors, we all have different needs and different investment plans depending upon our investor profile. So what is this investor profile? Well, it's something that will vary for every investor. It depends on an individual's attitudes, personality, and personal situation. For example, the profile is determined by personal social aspects such as age, income, wealth, and tax. Personality traits, the way you react emotionally, your attitudes and beliefs, the investor's attitude to risk and return. So you can understand from these major points that we are all different, all very different as individuals, and therefore we would have very different investment plans. An investment plan should include the strategy of how the investment is going to be managed, whether, for example, it's going to be a buy and hold investment. It should include asset class investment. Are you going to invest in Australian stocks or international stocks or in cash? How will you enter the market? How will you sell? What sort of diversification? What's the limit of the number of stocks to be held or limit in any one sector? And what's the attitude to risk management? Consider the following example of an investment plan. This is the investment plan of Alan Hull. I use Alan Hull's investment plan as an example because it's very simple but very comprehensive. It includes excellent risk management strategies. The actual time to manage the investment is very small, and it's a proven investment plan. It's been tested over quite a number of years. It is very profitable. Over a 5-year period, from 2001, it outperformed the ASX 200 index by nearly 22%. Let's look at the specifics of Hull's investment plan. He trades only Australian shares, in fact shares in the ASX 200. He selects the fastest trending stocks in the index. Available funds are invested equally in the top 10 stocks. Stocks must be liquid, and a maximum of 4 stocks are chosen in any one sector. There's strict money management with a maximum loss of 2% on any one stock. There's strict rules for selling, and the portfolio is managed on a weekly basis, placing the order in the market on the Monday. Hull's is an excellent example of an investment plan. It's carefully thought out and tested. We're going to discuss Hull's investment approach in some detail in later sessions when investment strategies are considered. Consider this as an exercise. I'd like you to assume the role of a financial advisor. You have a client who's asking you about an investment plan. So what do you consider should be included in your client's investment plan? And I'd like you to list the 3 most important points in the investment plan from these following options. First of all, risk management strategies. Which stocks to buy, in other words, stock selection. How many shares to buy, looking at specific risk. How and when to buy the stocks, market risk. When to sell, rules for selling. And how to manage the open position. What you could do at this stage is pause the video and determine which of these 6 points you would consider most important. I'll give you a few minutes to consider this. Now let me suggest, if I was in this position and having to select just 3 of these 6, which ones I would choose. Risk management strategies, absolutely essential, I'd include that. Specific risk is essential, I'd include that. And rules for selling, I'd include that. So from my viewpoint, I'd select those as the 3 most important. In making the decision to select 3 of these 6, certainly risk management strategies is the most important and would have to be included. I believe that specific risk is very important and should have a place there, and you may have decided that in your top 3 you had a different order. Let's now consider an important exercise. At this point, it would be very useful if, as an exercise, you outlined your investment plan. If you already have an investment plan, it would be appropriate to consider if any changes should be made in the light of our discussion during this session. Well, that's the end of our first session. In the next session, we consider the analysis of stocks and markets, and we look at fundamental analysis.